Here's a chart of my top 10 stocks to buy right now, half of which I currently own and half of which I've never talked about before on this channel. We'll alternate talking about one stock that I own, followed by one stock that I don't own, and work our way up to my single largest investment that I've ever made in my portfolio, and it's different from last month. And at the very end, I'll show a pie chart of my entire stock portfolio as it stands today, including some pretty big changes from the last month. This can give you a starting place to find your next great investment, or just show you some ideas you can research on your own. So let's start by showing my actual stock performance this year. So I have pulled up here my actual personal Charles Schwab account that I invest in. Currently, the total value here is $143,000, and over the last 6 months, it's gone up just under $10,000 overall. We can see that for the start of the year, it was down a little bit, it continued dropping before rising through the rest of the year, and then dropping a little bit in the month of August. And that dip in August is from companies reporting earnings, which I will be talking about later in this video. So the first stock that we're going to be talking about is a new company that I started investing in, Monday.com. I've invested just over $11,000 in this company that is revolutionizing the future of work. Monday.com is like the Swiss Army knife that companies can use to collaborate between their teams. They have different platforms for different types of users. For example, if you're a creative designer, you need different tools than a software development team or a marketing team or a project management team. Monday.com allows each of these teams to collaborate effectively in ways that are unique to them. Monday.com is still a relatively small business. Their stock price is up over 30% for the year, but their entire market cap is still just under $8 billion. But despite their small size, they punch above their weight. Their customers include companies like Coca-Cola, Canva, and Holt. And we can get an understanding for how ambitious this company is by looking at the name of one of their products, WorkOS. Monday.com wants to become the operating system that runs beneath your entire organization. And they want to build the future system that hybrid work models will run on top of. The company is growing at 42% year over year in terms of their revenue, and their number of customers with more than $50,000 in annual recurring revenue grew 63% year over year. This is a big deal because recurring revenue is revenue you don't need to resell to maintain growth. As an example, imagine a shoe company. They sell $100 million worth of shoes this year. Well, to grow 20%, they would need to sell $120 million worth of shoes next year. Now let's imagine this is annual recurring revenue. Let's say Monday.com makes $100 million in annual recurring revenue. Well, in order to grow 20%, they only need to sell $20 million in additional revenue because that $100 million carries over from the previous year. This can make their growth rates absolutely insane when they stack up enough of this annual recurring revenue because they always have that base that they can grow off of. Now, while this is an impressive company, not everything is perfect. If we look at their GAAP income, they actually lost $12.12 million this quarter, although compared to a year ago when they lost $46.2 million in the second quarter of 2022, that's actually a pretty substantial improvement. They lost $34 million less this year, which means they may soon start to see profitability. And maybe even more important than that, they are already seeing positive free cash flow of nearly $46 million, which I think is actually even more important than profit, but I'll talk about that more in one of the later stocks. And with this company rapidly improving profitability, customers using more and more of their product, even while other companies are seeing customers cut back on spending, and their great strategic positioning for the future of work, Monday.com seems really strongly positioned both in the short term and in the long term, which is why I invested. But that's only a mid-sized position for me. Make sure you stick around because I'll be going into my second largest and even my largest overall position, which I put over $20,000 into. Next up, we have a company that I've never invested in, but I probably should have, considering this company is changing the way the world runs, perhaps more than any other company in existence today. Nvidia is a weird company. They started out making graphics card for gaming computers, but if you go to their website today, you're more likely to see enterprise software and AI and simulation tools that their cards enable. And what's really interesting here is every last tech trend that we've seen over the last decade has had Nvidia at its core. Blockchain, people were buying up graphics cards like crazy. Metaverse needed expensive GPU processing to power all the virtual reality pieces. And now even generative AI is getting on board the bandwagon, with many companies creating their own customized chips that can run generative AI on top of them. And no one is farther ahead in this arena than Nvidia. Nvidia's stock price is up a ridiculous 216% year to date, and at this point, the company is worth more than $1 trillion. For context, that is worth more than Meta and Netflix combined. Pretty good for a company that used to just make video game hardware. Now, Nvidia has seen some struggles in their recent financials. A year ago, they made $6.7 billion in revenue revenue, but over the last couple quarters, they've seen their total revenue start to decrease year over year, as evidenced by this metric right here. But at the same time, they're making more net income than ever, meaning the company is becoming more efficient. For a company at this scale, that's really the key here. Nvidia's already such a big player in the graphics market that there's not that much room for them to take over. At this point, the two ways that Nvidia grows are to make more money from their existing customers or for the market itself to expand. They're not really going to win that much from their competition. But we are seeing the market expanding incredibly quickly, especially with the exponential effect that generative AI is going to have. And so even though I don't currently own Nvidia, this stock is definitely on my radar. The next stock that I own is a company that I've talked about before on this channel, but there have been some major changes in the last month. Sofi is a fintech company. They are revolutionizing the banking world by, on one hand, winning over the 500 million plus legacy bank accounts, and on the other, building the next generation fintech platform. Pretty soon, other fintech companies are going to run on top of Sofi's platform, much like Netflix runs on top of Amazon Web Services. Sofi could become the AWS of fintechs. Imagine if you become so dominant in a given space that even your competitors have to pay you to use your platform. Oh wait, Robinhood's been running on Sofi's Galileo technology platform since Sofi acquired that company. Now, Sofi has always been sort of a long-term, big, risky bet. They're essentially three businesses in one. They have their financial services, which includes things like the Sofi credit card, the Sofi checking account, and Sofi Relay for budgeting. This is where they capture new customers and they burn money. But then they funnel these customers down to Sofi Lending, the core bread and butter of their business, where they make most of their profits. Sofi's been aggressively expanding into the loan market recently. They started out with just student loans. Then during COVID, when there was a cancellation on student loans, they pivoted over into personal loans. And now they've even moved into mortgages and auto loans. And by combining those two sections of the business, Sofi is able to capture customers really cheaply and then make a ton of money on them in lending. That then leads to the third part of their business, their technology platform. This is Sofi's long-term play to completely take over the fintech market, where they'll provide the technology and the expertise to actually run fintech services, and other companies can just build on top of that base platform. And if this sounds kind of like what Amazon did, where they launched an e-commerce platform that completely took over, then they sold the technology used to run that platform to other companies, you would be right. Sofi has the exact same plan, except in the fintech space. And even though that's a long-term bet, we're starting to see that bet pay off in their actual earnings numbers. Sofi recently reported that their financial services segment, which historically has been their loss leader, has become operating income positive. This means that starting today, every new product Sofi sells for their checking account or their credit card makes the company money. Now, they don't yet make enough to cover all their fixed costs, but as the company grows from here, they simply make more and more money. Add on to that in the short term, student loans are going to be coming back soon, and we may start to see people who had formerly paused their federal student loans realize that they can refinance to Sofi and get a better rate. So Sofi has several potential catalysts in the short term that could boost the stock price, and they have a really ambitious long-term vision, which is why I invest in this company. And remember, at the end of the video, I'll be showing you a full list of all my investments. But next up, we got another company that I don't currently own, which is one of the largest companies in the world that single-handedly created the cloud space and is starting to show some really interesting moves into AI. Amazon is a company you might not expect to see their stock price rise 55% in just the last year, especially considering their market cap is now $1.37 trillion, which is really crazy when you think that they've created over $500 billion in value in just the last year. Now, everyone knows about Amazon's e-commerce segment, their giant mega internet store that's completely taking over the commerce space. But for this stock, I want to focus on a different area. See, Amazon is such a big company that realistically, they're going to be valued roughly how they should be. So the only way that we as investors could make a return in this stock above what the market expects is to see something that the market is undervaluing. The area that I see could be undervalued is Amazon Web Services, and specifically Amazon's approach to AI. ChatGPT has been all over the news recently, with everybody talking about how it's going to revolutionize AI, and it absolutely will. But Microsoft has an exclusive agreement with ChatGPT for their Azure cloud platform. This has led a lot of people to start picking ranking Azure as the winner over AWS. But I don't think Amazon is out of the running quite yet. You see, ChatGPT is just one type of model that generative AI can produce. It's a large language model. It's really good at making text. But with this new technology, you can generate pretty much anything. You've probably seen generative images, maybe even generative videos and voices, and Amazon wants to take a much broader approach. With generative AI on AWS, their goal is to let you pick your own models that you can then run on top of their platform. You could train your own model that does something that no one's ever seen before. Yes, you can use existing models and you can customize them a little bit to accelerate your workloads, but real serious AI companies are going to be training their own custom models. And when they run those models, more than likely they're going to run them on the largest cloud provider in the world, which is AWS. Amazon even gives some different examples. Amazon Code Whisperer allows developers to work alongside AI to help generate code for them, increasing productivity. The Allen Institute is mapping the human brain using generative AI, and Canva, of course, is using generative images to add to designs. I think Amazon is really well positioned as new technologies come out in the space because they have the best cloud platform in the world, and so any new technology that comes out automatically benefits them as long as they stay consumer focused. And we already know that that is Amazon's focus. They are customer obsessed rather than focused on their competitors, and their goal is to be the Earth's most customer-centric company. But now let's shift over to another stock that I own, which is a much smaller company than Amazon, but it's one that I've talked about quite a bit on this channel as the most innovative company in the world today. Cloudflare is a company that is trying to reinvent the way the internet itself works, and they have promised over the next 5 years to 5x the total revenue the company is producing. Now, when you think Cloudflare, you might have seen their logo pop up when you're trying to access a website. That's because Cloudflare's original service was basically a firewall. They would protect websites from bad actors. But they quickly realized that with all the traffic they were analyzing, they could also optimize the web experience for good actors. And from there, they began to launch product after product after product that would improve the way the internet itself worked. People forget, but the internet is basically 1960s or 1980s technology, and it hasn't really improved that much since then. Cloudflare is now inventing ways for workers to run workloads directly on the cloud in ways that are much faster than the large cloud providers, even like Amazon and Microsoft. And we've seen this rapid innovation show up in their revenue numbers up until now, with the last quarter, the company growing 31% year over year. But now Cloudflare is actually entering the generative AI space as well, and they may even have some advantages over Amazon. Cloudflare recently unveiled Cloudflare One, which is a tool that enables the safe use of generative AI tools. One of the big issues with generative AI is you don't want to be sending all your data to someone else that they can then use later. You want to keep it secure and encrypted and on servers that you control. Cloudflare allows companies to do this. One method that Cloudflare is using that a lot of other companies aren't is they're not actually charging for egress from their GPU instances. Basically, they let AI companies run their AI models on top of their GPUs, wherever they can get them the cheapest. And then they don't charge when data leaves those GPUs. They just charge for the time you're actually running them. This gives the AI companies a ton of flexibility to be able to find wherever the cheapest GPUs are and train their models on Cloudflare's platform. And they basically have a vision of two types of AI in the future. The first would basically run where you need the AI. So think of a driverless car. The AI is probably just going to run on the car's local computer because it's going to need to be faster. But if you need a really large, super intensive model, like for example, you're mapping the human genome, well, that's probably going to run somewhere on the cloud where you have a ton of different compute instances together that can all network together. And that is where Cloudflare has an edge over the competition. Cloudflare's CEO specifically called out on their earnings call that Cloudflare is uniquely positioned to win that inference market for those models that make sense not to run on the devices themselves, but to run at the edge of the network, basically on the internet, but with connection speeds fast enough to still use AI effectively. And for reference, I currently own $9,500 in Cloudflare. Next, we have another company I don't yet own, The Trade Desk. Someone in my stock group mentioned this company to me, and it sounded really interesting, so I decided to take a look. And don't let the name fool you, The Trade Desk sounds pretty boring, but this is a company that's increased its stock price by 65% year to date, while 1, accelerating revenue, and 2, actually producing a profit. I know, profit on this channel. Crazy. The Trade Desk is basically an online ads placement engine. The same way that Google automatically places their own ads on YouTube, the Trade Desk allows you to place those kind of ads everywhere else, outside of the big players like Google and Facebook. This is actually an incredibly data-intensive space where you need to try to unite different signals from the internet, from offline TV, all the way through to the stores where customers will eventually buy your products. And the Trade Desk is one of the leaders in that data space. If we look at this company's earnings over time, back in December, they made $490 million while growing at 24% year over year. Then they grew 21% and then re-accelerated to 23% growth in their most recent quarter. And all this while the company is making positive net income, which has increased 272% year over year. The fact that the Trade Desk has somehow managed to find a way to continue to grow consistently while also generating a profit and not being squeezed out of the market by companies like Meta and Google shows that they have long-term potential to grow in this market. And realistically, I don't really think that a Google or a Meta would even want to totally push them out because they provide some semblance of competition that prevents regulators from going after those big players. And more recently, I'm gonna start sounding like a broken record here, the Trade Desk has launched a new product, Kokai, which is a media buying platform that brings the power of AI to digital marketing. Look, we all know that generative AI is going to play a role in advertising at some point. The question is how soon and how effective is that going to be? The Trade Desk plans to be one of the leaders in this space, aggressively moving forward into this arena. And because they're smaller than a company like Google, they can do so a lot more nimbly and with a lot less public pushback. So now when a marketer is sitting there with all this data that their ads have generated, Kokai can sit there as a co-pilot alongside them to help reduce down that complexity and make it easier to serve the right ad to the right person, which is really a win-win. They don't see ads they don't want to see, and the ad buyer isn't wasting money showing ads to people who aren't interested. And now we're going to hit on two stocks that are in a completely different market than I've talked about up until now. And it's going to be one of the most important markets to the future of the internet itself. Next up, we have a cybersecurity AI company that is growing their revenue at 70% year over year. SentinelOne is a cloud-native AI-powered company. Their job is to use AI to proactively detect threats. The traditional security model looks at all the threats and attacks that have happened in the past, adds them to a big database, and then tries to compare new threats to that database. SentinelOne trains an AI on that core database so that it can proactively recognize new threats that it's never seen before. Their Singularity platform is their single platform that tries to unite all the different aspects of cybersecurity, protecting all the places where you connect to the internet, protecting the cloud workloads, protecting individual identities, and any data that is stored on the cloud. The basic premise behind SentinelOne is that it is impossible for any human to prevent cyber attacks at this point. The fact is, cyber attackers just move too fast, and with technologies like generative AI coming out, pretty soon attackers aren't even going to be humans. It's all going to be automated. So you need an automated response system, and SentinelOne provides that. Some of the companies that are served by SentinelOne include some pretty big names, including EA, McKesson, Cisco, Political, and Pandora. Now, if we look at SentinelOne's stock price over the past year, we can kind of get an appreciation for just how volatile this stock is. From the beginning of the year through June, the stock price rose 61%, and then it pretty much collapsed overnight by 40%. And then since then, it's risen yet again by about 20% until for the full year, it's basically just been flat. This is kind of the name of the game when you're investing in these very small hyper-growth companies. Very small changes in news can completely change the outlook in the stock, and then they can also very quickly recover from those drops. And I currently own $4,660 worth of SentinelOne. Now, on a similar note, we're going to be talking about SentinelOne's big brother, you could say, Crowdstrike. Crowdstrike is also using AI in the cybersecurity space, but they go from a slightly different angle than SentinelOne. While SentinelOne is the hyper-growing, fast, new upstart on the block that wants to automate everything, Crowdstrike is the respected leader in the space, showing up in the top right quadrant for Gartner's endpoint protection platforms, meaning they have the strongest ability to execute and the greatest completeness of vision. And Crowdstrike is also growing very quickly. If we look at their revenue in their most recent quarter, they made $692 million, up nearly 42% year over year. And if we look at their stock price, they've had a much more consistent rise year to date, up just under 49% with some volatility, but nothing like SentinelOne's. And while similar to SentinelOne, Crowdstrike does use AI in their platform, they take a bit of a more holistic approach. Their goal is to be the consistent, innovating platform that takes the ideas from smaller companies, implements them into their core Falcon endpoint protection platform, and then uses that to protect all of their customers. They They have a really strong reputation in the marketplace. Their CEO is often used to talk on different talk shows about the future of cybersecurity, and they've even stopped some major breaches in the past. For example, the SolarWinds breach, which was basically the largest hack in history that affected people like the DoD and Microsoft. Crowdstrike was actually able to prevent the SolarWinds breach and detect it and report on it before anyone else. And they've had similar success with other breaches in the past, which they've mitigated, such as the North Korea breach of Sony a few years ago. But now we get to my single largest position overall, which has more money invested in it than any one stock that I've ever owned. And after that, we'll also go over my full list of positions and the trades that I've made in the past month. So Snowflake is the single largest stock position that I currently own, currently worth around $16,500, although I have initially invested $22,000, so it's down around $5,500. The reason that I think Snowflake is down is because they're not yet profitable, and as we see some more economic headwinds, investors are pivoting from less profitable companies into companies that are producing profit in the short term, which I think is a mistake. Snowflake is currently growing their $623 million in revenue at 47% year over year. And while they are not profitable in terms of their net income, the company is producing positive free cash flow. Here's why that matters. When it comes to a recession, which is what people are worried about, cash is king. With cash, you can acquire your competitors. You can buy back the stock price if it drops too much. You can reinvest back into the business. Profit is more of an accounting term. In fact, it's possible for a company to be profitable and to still go bankrupt if they run out of cash. It's not really possible for a company to go bankrupt as long as they're producing positive cash, and Snowflake is producing tons of it. Snowflake is producing the data cloud, which is the future of how data is going to be managed by organizations. Rather than managing your own data in your own applications or even in your own cloud, companies are starting to outsource that to cloud platforms like Snowflake. You can kind of think of it this way. 1,000 years ago, people used handwritten spreadsheets to keep track of data. Then they eventually invented basic computers that had Excel spreadsheets. Those moved into databases, then data warehouses, and eventually into the cloud. Snowflake is the next order of magnitude improvement, inventing the data cloud, where they can manage all the data governance and making sure the right people have access, and companies can focus on collaborating with partners they want to share data with and making more money off of the products that they build. And data is only going to become a bigger and bigger deal as more and more companies move to the cloud, more and more IoT devices are created, and more AI applications are generated. Here's an interesting article by Fabio Duarte where he maps how much data is used every single year. So apparently 328 million terabytes of data are created each day. For context, a terabyte is 1,000 gigabytes, which is 1,000 megabytes, which is 1,000 kilobytes, and 2 kilobytes is a couple pages of text. They expect there to be 120 zettabytes of data generated this year, which is 120,000 million terabytes generated each year. That is an unfathomable amount of data. In fact, it's so much data that no human can ever use that much. We're moving into a world where simply having the data isn't valuable. What's important is what you can do with the data, how well you can filter the data, and what applications can consume that data. Snowflake covers all of this. They let you run AI or machine learning workloads on top of your data, connect with applications, secure that data, and run any kind of data engineering you need to on top of your core data warehouse, data lake, or Unistore. Snowflake also runs a marketplace where other people can build capabilities on top of Snowflake's platform, making it more and more valuable each year without Snowflake needing to invest in the research and development. There's tons of huge businesses that run on Snowflake. Capital One and JetBlue are just a couple of them. And even though this might sound like a bit of a speculative investment, actually value investors, like probably the most famous value investor in the world, Warren Buffett, is currently investing in Snowflake as one of their plays for AI and the cloud. Snowflake's always been a very highly valued company, but that's because their potential value has always been so clear, which is why this is one of my largest investments overall. Now, I did promise at the end of the video I would also show you my entire stock portfolio, so I'll throw that on the screen now. And I'll also tell you that in the past month, I sold a small piece of my Datadog position and my Bill.com position. So don't forget to like and subscribe, and I'll see you next time.